right, now we're going to do a little bit of commercial math. And personally, I find this really interesting. I think a lot of you do too. First thing we're going to talk about is cash-on-cash return. Now, a buyer wants to compare the cash income a building makes with the cash they invest to buy the building. I mean, that strikes me as a very sensible first step, right? So let's look at the question, and then we can analyze this a little bit more. Sam wants to buy a building for $3 million, and that's the price. Sam's bank has agreed to a mortgage of $2.1 million, so Sam's down payment will be $900,000. Before tax cash flow generated by the building is $150,000 per year. Before tax cash flow is income. What is cash-on-cash return? Now, the answer is before Sam buys the building, he wants to compare the building's income with the amount of his own money, the down payment, which we might call the purchase cost, he must spend to buy it. Before tax cash flow is simply a kind of income that Sam will see on the building's operating statement. So all we do is we take the before tax cash flow, divide it by the purchase cost, which in this case will be Sam's down payment, and that equals the cash-on-cash return, which is a percent. So we say $150,000 income divided by $900,000 purchase cost, and we find out that Sam is getting a cash-on-cash return of 16.7% if he buys the building. Now, let's think about this a little more, because what I find happens with the cash-on-cash return questions is that it's not that the arithmetic is hard. It isn't. It's just division. But people are confused because they don't understand why they're doing it. You see, Sam certainly cares if $3 million is a good price, but he's not asking himself that question at the moment. So the price of $3 million is not going to be used in the calculation. What Sam is asking himself is if he's getting a good rate of return on buying this building, because he's comparing the income that the building makes to the amount of his own cash money that he has to spend in order to buy it. Now, if he's not getting a good rate of return for his cash investment, maybe he should invest his $900,000 in the stock market or a business or race cars or something. I don't know. So the purchase cost in real life might include expenditures other than down payment, such as closing costs. But generally speaking, these questions are pretty simplified. So for all intents and purposes, the purchase cost will generally be synonymous with the down payment. Now let's do potential gross income. Pam's building has 100 units with $1,500 per month market value for each unit. 11 of the apartments are vacant. Laundry machines in the basement make $2,000 per year. What is effective gross income of the building? Now, to answer this question, you have to know the definition of potential gross income. Potential gross income is the maximum rental income a building would make if all the units were rented with no vacancy and no collection loss. What we mean by that is that all the tenants pay their rent. So we take 100 units times $1,500 per month times 12 months, and we wind up with 1.8 million potential gross income. Now, the trick in this question is that they give you information that you don't need. The definition says rental income, so you don't care about the laundry machines. And the definition also says no vacancy, so you don't care about the vacant units. Once you eliminate the information in the question that you don't care about, then it becomes a very simple, straightforward question. But please remember to multiply by 12 months, because potential gross income is typically calculated as an annual figure. Okay, I'd like you to meet Irv. I always say that Irv is my boyfriend because we use Irv every single day in commercial real estate. Now, you notice Irv has a little name tag here. I can't resist telling you a funny story. I have a friend in the real estate industry, and every time he goes to a convention, you know how they give you those little name tags? As a joke, he always puts his name down as Irv, hoping that other people will get the joke. Anyway, IRV is not really a person. IRV is a math equation that you do use all the time in commercial real estate. And we're going to have to get pretty used to it because I promise you it will be on your licensing exam. Now, IRV stands for I divided by R equals V, which is income divided by rate of return equals value. Now, this is something that we discuss in great detail in the commercial chapter, which is chapter 16. For now, we're just going to be doing the arithmetic. Now, the terms of IRV can be put in any order. I divided by R equals V, I divided by V equals R, or I equals R times V. How do you know which one to use? Well, when you're doing math questions with IRV, always use the equation where the thing you don't know is by itself. So in other words, if you don't know value, make sure that value is alone on one side of the equation. IRV is based on the idea that the value of a commercial building is based on its income. So let's try a question. Sam's building makes $150,000 per year net income. Pam will buy the building if she can get a 6% rate of return. How much should Pam pay? Well, here's the answer. This question is asking what is the value to Pam based on the net income. Remember that IRV always uses net income, never gross. The terms in IRV can be placed in 3 different orders. It is easiest to use the equation where the thing you don't know, in this case value, is by itself. Income divided by rate of return equals value. 150,000 divided by 6% equals 2,500,000. Here's another IRV question. A building sells for $600,000 at 8% capitalization rate, or if you're cool, you call it cap rate. What is NOI, net operating income? Now, although the test uses very few abbreviations, NOI is one they do use, so please be sure you remember the meaning, net operating income. So, dollar income equals percent rate of return times value. The income equals 8% times 600,000. The income is 48,000. Let's try another one. Pam has $300,000 to invest and wants to buy a building for $1 million. If the building's gross income is $90,000 per year and expenses are $40,000 per year, what is the cap rate? Now, this is definitely an IRV question, but the terms of IRV are not given directly. Unfortunately, you have to calculate the net income. It is not given to you. Also, the question tells how much Pam plans to invest, which is not necessary for the IRV equation. So first, calculate the net income by subtracting expenses from gross income. Gross income minus expenses equals net operating income. So we take the gross income of $90,000 minus $40,000 expenses, and we discover that the NOI is $50,000. Then we take good old IRV. Income divided by value equals rate of return. $50,000 NOI divided by $1 million in value equals 5% rate of return. Now we're going to discuss commissions a little bit more. Here we're going to contrast net price and sale price. According to real estate license law, real estate commissions can be anything with definite value. A car, a trip, a service, all have definite dollar value. Commission can also be a percent of sale price, which is a dollar amount. Commission cannot legally be an unspecified amount. The seller cannot say, I want $1 million for my property, and any amount it sells for above that is your commission. Can't do that. That's a net listing, and it's illegal under New York state law. So, salespersons and brokers cannot list properties at net price, but at asking or sale price, which includes commissions. Sale price includes commission. Net price does not include commission. Here's how to figure a property sale price based on net price. The net price divided by the percent to seller equals sale price. Now let's say the net price is $150,000 with 6% commission. If the broker gets 6% of the sale price, the seller gets 94% of the sale price, because 100% of the sale price minus 6% commission equals 94% left for the seller. 100 minus 6 equals 94. So we take the net price of $150,000, we divide by 94%, the amount that will be left to the seller, and we wind up with the sale price of $159,574. So to put it in other words, the property must sell for $159,574 in order for the seller to wind up with a net price, a net dollar amount of $150,000. Now let's take it a step further. What if the broker commission is not the only expense in the sale? The price would have to cover all those expenses, wouldn't it? After paying things like closing costs and mortgage payoff, the seller would end up with the net price. Now, let's say it's you that's doing all this. Let's say you want to end up with $150,000 on your home sale, but closing costs are $11,000 and the mortgage payoff is $50,000. Also, you have to pay your broker 6% of the sale price, not the net price. And that's very important because commissions are always calculated on the sale price, not the net price. First, take the amount you want to end up with, which is the net price, and add all the expenses except for commission. $150,000 plus $11,000 closing cost plus $50,000 mortgage equals $211,000 net price. Now you have the total net, including expenses you need to cover. Now, remember the equation? Just plug in the numbers. Also, please remember that if broker commission is 6%, the seller, who's you in this story, gets 94%. So you take the net price, which is $211,000, because remember we added the expenses in on top of the final net price, divided by 94% to the seller, and we discover that the sale price is going to have to be $224,468. A percentage lease is when a retail tenant pays landlord a percent of sales in addition to, or instead of in some cases, rent. Let's look at the question, and I think that the question will explain this best of all. Sam pays $60,000 per year base rent for his jewelry store, with 7% overage. If Sam's in-store sales were $750,000 this year, how much total rent did Sam pay this year? Answer. This question describes a percentage lease with a natural breakpoint. That means Sam pays base rent every month until his sales reach a certain breakpoint number, at which time he also pays rent on his sales above that dollar number. First, you have to calculate the breakpoint number, because we don't know what it is. They didn't tell us in the question. We do that by taking the base rent, which is an annual figure, divided by the percent overage, and we wind up with the dollar breakpoint. So $60,000 per year base rent divided by 7% overage equals a breakpoint of $857,143. If Sam's sales were only $750,000, he never reached the breakpoint, so he never had to pay any percentage rent. Therefore, the total rent Sam paid to the landlord was the base rent, $60,000. Now, what if Sam's sales did go over the breakpoint? What if Sam's sales were actually more than $857,000 this year? Well, let's try it out. Let's say sales were $900,000. Then Sam did go over the breakpoint. You would subtract the breakpoint from sales and Sam would pay 7% of the sales above the breakpoint. $900,000 in sales minus $857,143, which is the breakpoint, equals $42,857 in sales over the breakpoint. The 42,857 sales over breakpoint times 7% overage equals $3,000 percentage rent. And as you can see, I rounded that off. I rounded off the $3,000. $60,000 base rent plus $3,000 percentage rent equals $63,000 total rent.